Welcome to the first Captive Solutions from Marsh webinar of 2021. And wow, we've got a lot to tell you. This is a teaser, if you will. Normally by now we're talking about our annual Captive Landscape Report. This is a little teaser of information. The Landscape Report will not be out until mid-September, but we just couldn't wait to tell you the information that we've got as we pulled all the 2020 data together. And that's just 2020. We haven't even got on to what's happening in 2021 yet, or we've had five or so months of that. You can use the chat feature during this session if you have any questions, and we'll try and get to those. Also, you can reach out to us by email or phone. Most of you know how to contact us, and if you have any questions. Now, many of you will have been listening last year to our 2020 series, 20 minutes at 20 past the hour all throughout 2020. But I don't really want to repeat anything that we did in 2020 because it was a bit of an unprecedented year, and I swore I'd never going to use that word again. So we're not going to call this series 2020. In fact, we're not even sure what we're calling this series. All we know right now is we want to bring you some data and some insights right now of what's been going on. So stay tuned, and we'll give you up-to-date information as the year progresses. But right now, we just wanted to share with you what's hot, what's top of mind, and what's happening in the captive industry from a Marsh Captive Solutions standpoint. So with that, I'm going to move in and introduce my co-hosts here. We have Mike Siricchio, who is the Americas Sales and Advisory Leader for Marsh Captive Solutions. Lorraine Stack, who's our International Sales and Advisory Leader for Marsh Captive Solutions. Lorraine is based in Dublin and Mike is based in Connecticut. And I'm Ellen Charnley. I should have introduced myself earlier. Many of you may know me already. Many of you may not. I'm Ellen Charnley. I'm the President of our Global Captive Solutions at Marsh. So the two highlights there for the agenda is to talk a little bit about our benchmarking data sets and talk about what we've seen, which really we've described as some historic growth in captives in 2020. So welcome, Mike and Lorraine. Thank you so much for joining me. This session will probably be longer than 20 minutes, but probably not too longer than 40 minutes. So maybe somewhere in between there. So do please ask questions as we go along. So Mike, let me just kick the first question to you. We had a crazy number of formations in 2020. We're talking specifically about the data in 2020. Can you tell me a little bit about that and what really caused that level of growth that we saw in captive formations?
Sure, Ellen. Thanks so much. The growth really was historic, unprecedented, more than double our best year ever. So we formed more than 100 captives of all types of entities, single parent captives, risk retention groups, sales, group captives. And really the reason for it is two words: the challenged market, or as some people like to call it, the hard market. And it's really driving clients of all sizes, of all industries, in all regions to kind of think more about, their property program, their excess liability program, D&O, products liability, products recall. These are all lines of coverage that are just really giving a lot of pain points to clients. And there's no doubt in my mind that is why we saw this historic formation in last year. And that's really going to continue. And in addition, many of the captives that were dormant, or many of the captives that were writing a decent amount of premium, they grew their lines of coverage. They grew the coverages that were causing them the most pain. And interestingly, our largest captives, and we manage a fair amount of captives, over 1,500 captives, and the captives all around the world that wrote more than $20 million worth of premium, which is just pretty large captive, they grew by about 5%, showing that they're constantly looking with their brokers and looking at what they can do, how they can leverage their captive, how they could take premium perhaps out of the market, raise retentions, being forced to do certain things. And the captive was that perfect vehicle to kind of, bridge that gap. And it's just a testament, I think, to this industry and to what we're doing here, that captives are really thriving like this.
And Mike, just in case we've got some brand new captive owners or some clients who are interested in captive, just a quick 101, like typically in a challenging market, we see growth in captives. And why is that? Would you just, a quick 101, explain that?
Yeah, sure. So in a challenging market, the capacity is not there, the premiums are going up. There's pressure from your stakeholders, maybe your treasurer, your CFO, your CEO, looking at all lines of coverage, trying to drive out costs in every single way they can, looking under every single rock for savings. And captives are is that natural vehicle and that kind of flexibility and optionality to figure out, okay, let's do something a little bit different next year. Let's form a captive. Let's take our retention up. Let's use some data and analytics. At Marsh, we've got tremendous amount of data and analytics and risk financing work and risk-bearing capacity analysis that allows clients to make educated decisions on how to react to the market and drive down their costs and risk finance in a better, more efficient way. And that's exactly why you're finding that this increase was so large over the last year, and it will continue. But even in soft markets, we found that, captives generally have been increasing. And that's for a whole host of different reasons as well, like third-party profitable business and, wanting to take more risk and wanting to look, feel, and act more like an insurance company. And that's exactly what captives allow you to do.
Yeah. And that 100 formations, folks, it's unprecedented. I promised I wouldn't use that word, but I'm using it again. We've never had that, at least in my memory, we've never had that amount of formations. And yeah, like Mike, that's more than many captive managers actually manage in entirety. And so we have more than 1,500 captives that we manage, and what that means for you as the clients is that essentially creates more data, more experience, more capacity, more staff, more resources, more technology. So we're very proud of that, and we're certainly seeing that continue into 2021. Although you're gonna have to wait for that data for sure. Okay, Mike, another question for you. What type of captives are being formed?
Sure. So it's common that single parent or wholly owned insurance companies captives are the most common type of captives. But what we saw in the last few years is that rent-a-cell, protected cell, whatever term they're called in the domiciles, are really growing. And cell captives are so efficient. They're relatively easy. They're a little bit less expensive to run. They're able to plug and play quickly at a renewal, that the cell captive really increased over the last year. And I think you're going to find that this phenomenon will continue. Like I said, everybody wants efficiency. You want to be able to start up a captive in as quickly as a few days in some domiciles and a few weeks in others. And in the Americas, at least, you saw that Washington, D.C. and Bermuda were the largest cell captive utilization domiciles that grew the most. But internationally, you saw a lot of growth as well. And I think that the whole theme about optionality and flexibility and the different cells that we offer around the globe are able to plug and play for excess liability. They're able to fund for D&O. They're able to be a pass-through for property insurance. You're able to take the large retention quickly. Parametric insurance for wind and quake are things that we're talking about every single day. And rent-a-cell captive cell facilities that we have vast experience in are really allowing and promoting clients to do this quickly. And it's just another option. And that's exactly what clients need. And especially in the middle market. So you've had a lot of captive owners that were large, but I would say in the last 10 years, and especially last year, you saw a lot of middle market, large, private organizations entering the captive market, and a cell captive is usually a really good way to start.
Yeah, Lorraine, what are you seeing in the rest of the world outside of the Americas?
So, hi everyone. Yes, so there are over 70 captive domiciles around the world, and in a subset of these where captive or protected cell legislation exists, this is where you can actually form cells. And this graphic here shows our cell facilities around the world. And outside of the US, there are three main facilities, and that would be the Isle of Man and Guernsey, that are really fed by the UK and Ireland. and then Malta, really, which is really fueled by continental Europe. So what we're seeing, Ellen, is a lot of the similar motivations for setup, which would be pricing, capacity issues. What's fueling Guernsey and Isle of Man in particular is the UK pricing. Commercial insurance pricing is amongst the highest in the world. So that's really fueling growth in Isle of Man and Guernsey. And we're speaking to a lot of UK companies that have never looked at a captive before. They're thinking about forming for the very first time. So we're speaking to a lot of new companies. And also what's helping in Guernsey in particular is, so Guernsey have recently implemented a fast track implementation program for single lines of insurance being formed in sponsored entities such as ours, our mangrove facility in Guernsey. So you can actually establish a captive cell immediately and then follow up with an application 2 weeks afterwards. That's really helpful there. And I hear from Nick Gale and the Isle of Man that Isle of Man are considering that as well. So that's really what's driving those two locations. And in Malta, somewhat similar, we've got pricing and capacity, but also importantly fronting, because from Malta you have the ability to front into the rest of Europe. And we're seeing a lot of difficulty because the fronting options in Europe for property and auto in particular are becoming very sparse. And there's a lot of capacity out there. So our placement guys are all telling, our Marsh and Guy Carp colleagues are telling us, look, there's factory placement out there. It's just trying to get into Europe is tough. So using a Malta facility, then we could potentially do that. Another thing we haven't, maybe actually, Mike, you mentioned it, but D&O, right? So D&O, single parent captives, and we'll look at the premium in a little bit, but the side A D&O for companies who can't get it in the marketplace, and there are some of those are looking at sales. So we have a number in Bermuda. We're actively forming a D&O side A cell in Guernsey, and we're very close in Malta as well. So, and the timeline in all of these, of course, is critical. And so I know in the US, you can form a cell very quickly, up to 4 weeks, possibly even quicker in Guernsey and Bermuda. Bit longer in Malta because we're still in a Solvency II regime there. So it might take 2 or 3 months, but still much faster than a single parent captive.
Yeah, the D&O growth and value proposition of a cell has been really interesting. And whilst it's not necessarily been tested in court yet, for some organizations, it really is the only option they've got left when they can't buy it. So separating out funds and putting it in a regulated entity provides some level of sort of robustness, if you will, I think. And so that's why we've seen some growth in Bermuda in that regard. There's a question here that's just popped up, Lorraine. Sorry to put you on the spot, but Vitas, I think I remember Vitas has asked, can an Isle of Man or Guernsey cell cover an Irish domiciled company? Good question.
It's a great question, and yes, but only on a reinsurance basis. So you can't write directly from the Isle of Man or Guernsey into Ireland. You need to have an admitted coverage in Ireland.
Very good, very good. All right, keep those questions coming. So let's move on. So we're now going to talk a little bit about the type of coverage. We talked a little bit about D&O, so we've sort of done that one, but we've got some other big numbers throwing out on this page here. Medical stop loss 81%, cyber growth of 54%. Tell us a little bit about this, guys. What are you seeing here, and what's been driving this?
Sure, Ellen. I'll start off and then I'll pass it over to Lorraine. But it's interesting that if you look at the growth numbers for these lines of coverage, 7 years ago, clients may not even, with the exception of perhaps cyber, clients and captives, it just wouldn't have been thought of. And it's just such an amazing testament that says when there's an issue in the market, D&O insurance and a captive can become very relevant. And cyber for the last 5 years has been growing hugely. And 15 years ago, you would have never seen cyber in a captive. And you're seeing that continued growth is amazing. Excess liability is one of those coverages, and I sort of call it the top 4 that are the biggest pain points in this challenge market, that allows clients to put different layers of their excess, plug and play, take a quota share, allow a gap to be placed, have great negotiating leverage with your carriers, have insurance below and above where you need it with a regulated insurance company. And that's exactly why you're seeing excess grow in the way that it is for so many companies. I mean, there's probably not a week that goes by where I don't talk about property, excess, D&O, or some form of those coverages, and how a captive can help, how we can bridge the gap, what we can do to kind of get through this renewal. And a single parent captive that's been around for a long time can easily kind of be deployed. A rent-a-cell cell captive can be easily kind of formed. And then you've got medical stop loss, which is generally a January coverage. So now is the perfect time to start thinking about that. But that's overnight premium savings that we've had great success leveraging the reinsurance market to save companies 10, 20, even 30%. So that's one of those things that we always talk to clients about that says, think about medical stop loss. Although it's a different stakeholder group than you're used to, bring HR in, talk about the concept, and figure out how collectively your captive can help save some money and maybe even pay for the startup costs in the first couple of years, just with the savings you can derive from medical stop loss. Property insurance in 2020, we wrote just the new forms, the new captives that formed in 2020. Marsh wrote over $500 million worth of property coverage in just that 1 year. And that, of course, next year with our benchmarking statistics will be probably one of the largest growth premiums that we see, property, excess, products, and D&O. So that's a little bit about what we're seeing, and maybe I'll turn it over to Lorraine to talk about the rest of the world.
Well, first, yeah, Mike, first just taking a step back and looking back at the correlation. I suppose it's not difficult to see the correlation between a challenging insurance market and increased premiums into captive, at a simplistic level, kind of all boats rising. But what's happening actually is fascinating this time, as it actually really highlights how, that captives and commercial insurers are all part of the same ecosystem, and really how interactive and interconnected the two sort of areas of the ecosystem are. And, we're seeing, time and time, I've had so many conversations with prospective captive owners and through feasibility studies. What we're seeing is that, companies who form captives still buy insurance, right? So they're still operating in the insurance market. They're just doing so in a more strategic and cost-efficient way. So it's not like there's a flight of premium from the commercial insurance market into captives. In fact, what's happening is there's the analytics, Mike, that you described earlier. So companies are actually looking at, to find that value inflection point, like what's the right balance between risk retention and risk transfer, and loads of them are using analytics to underpin those discussions, those decisions. So just to give you a few examples then, on property, we're seeing, increased layers, increased retentions to free up capacity, putting that in a captive to free up capacity higher up in a program where the capacity is really needed. On D&O as well, that 50% premium increase this year is on top of a 25% premium increase that we saw last year. And it's just going up and up. And what's really happening there on D&O is that you have companies who are putting, a higher retention of their B and C into a captive, and then that allows them to purchase more side A then in the commercial insurance market. And then, as we talked about, side A, maybe putting that into a cell if they can't get the coverage, allowing them to get coverage maybe for B and C. So there's lots of activity, and there's a lot of lines of insurance that aren't even on this. So multinational pooling, I know, is another one that isn't appearing on this, but we're seeing a lot of growth in as well. So growth across all premium lines, I would say.
Yeah, I mean, it's a lot to unpack here, and we've loads and loads of questions that are coming in. So I'll just caveat it by saying we're not going to be able to get to all the questions, but we also have a client-ready, very easy to read white paper on placing using a cell for D&O, or what to do with D&O. So we can certainly share that with you guys. But basically, that is definitely a hot topic. I understand that. We had a question in saying, from Nathan saying he has a single parent captive. They're a large FI. If we wanted to write cyber through the captive, does that need to be AM Best rated per regulatory requirements? I think it's a question. It may be, it may not be. It depends on who you're offering or who you're providing that evidence of cover to, and whether they require it to be an AM Best rated captive. We haven't got any information on our growth in rated captives, but that's on the increase as well. And it's certainly possible to get your captive rated if indeed you needed that and you preferred not to have a front. Okay, I'm gonna move on to the next slide because I think this helps answer a couple more questions. So this is the lines of business, but let's talk a little bit about the industries that have been growing. And I'll just answer a quick question from my good friend John Lambdin. He'd asked if there's any group or industry captives forming, and the answer is yes, yes, and yes. So we've seen particularly group captives forming in the automobile space, RRGs forming, risk retention groups forming. We've seen quite an increase in that. But Michael and Lorraine, tell me a little bit more about this slide. What are you seeing?
So, well, FI, financial institutions, that 15%, it's kind of a small bubble, but the reality is that because FI is the largest, our single largest captive owner group, that 15% actually is a big number. So that's like 38 captives, new captives, FI captives. So that's absolutely a big number for us. And some of that growth is life cos down in Bermuda. We're seeing lots of different lines of insurance then being written by FIs, such as E&O, D&O, bonds and stuff. Mike will probably talk about the US in a second, but on the auto, 28%, that's 77 growth or percent growth over 5 years. So that's constant, that's consistent now growth in auto. And we are seeing that, a lot of that is in the US, but we are seeing that in Europe as well. So I do expect, we're actually working on some projects at the moment for European fleets. I mentioned the fronting issue that's happening in Europe. So that's creating some need here. So we'll definitely see some growth there. Sports, entertainment and events, of course, hit so badly during the pandemic. So that's understandable that we're seeing some growth there. Mike, what's the story in the US?
Yeah, sure, Lorraine. So financial institutions, obviously, banks, insurance companies, professional services firms makes up the largest amount of captives globally. But we saw over $7 billion of new premium in 1 year. And those coverages were for E&O, for example, professional liability. We did see some captives get AM Best rated, and AM Best and other rating companies quickly responded and allowed companies to perhaps not buy the insurance that they bought in the past and use their captive to provide financial assurance and have an A- rating, for example, for certificate reasons. We saw D&O, as we talked about a lot, side A, B, and C. And the question about fully funding limits, partially funding, do you do it in a cell captive, or all the reasons why this will be continuing for the next probably several years. FI bond, that's something that constantly is being put in financial institution captives, as is a good amount of third-party business. We're going to talk a little bit about that, but financial institutions are very connected with customers, banking relationship customers, lenders, vendors, and they're doing third-party business for profitable diversification reasons. Obviously, the auto industry we talked about, we had a lot of large auto captives that perhaps kind of plateaued last year, and their captives gave back in the terms of intercompany investments and loan backs in the time when that cash was desperately needed. And captive regulators around the world and around the US kind of responded. And again, sports entertainment, hospitality and gaming was another industry that grew as well, for things like property and wind coverage and coastal properties. And parametric is a word that constantly comes up. Probably every week I'm having a conversation about wind, flood, quake, and how captives can be a pass-through, how we can use reinsurance to do it a little bit differently, take out some of those sublimits and some of those SIRs or deductibles for those big challenging wind, cat, nat cat, quake, And that's something that I think is certainly my prediction is that you're going to see a lot more parametric in the next couple of years.
Yeah, I would agree. A couple of questions have come in. Well, actually, they're streaming in, but let me see if we can hit off a couple of them. Maybe this one to you, Lorraine, from Martin. Can you please discuss increases being experienced in the challenging markets for FINPRO lines, financial lines, and professional indemnity, particularly in Ireland? I think you and I chatted about that the other day, in fact, right? Yeah.
Yeah, absolutely. So professional indemnity, really tough. UK and Ireland, really tough market. And I actually mentioned the correlation then between the cell activity in Guernsey and Isle of Man. Yeah, look, it's really tough. We're actually forming a cell right now in Guernsey. What we're doing is it's a construction firm in the UK, and they're having difficulty finding PI coverage, and particularly for cladding. This will mean something to our UK colleagues on. And so, the capacity and the coverage just isn't available in the marketplace. So what they're doing is they're forming a cell to be able to write that coverage directly into the UK in that cell, and then they're purchasing insurance then on top of that, but they're fully funding that that cell. So yeah, absolutely. I would say Martin, contact me, because there's a lot of activity around that, and I don't want to get into the specifics, of course, here on one subject, but we're getting.
Yeah, no, that's good. And just trying, Jackie's asked about, can we explain a little bit more about third-party business? Hold fire, Jackie, that's coming. And I feel like a TV talk show host here. This is very fun. Mike, do we see any captives insuring excess workers' comp? I think the answer is yes and yes there.
Yes, but we also see a lot of clients taking their workers' comp deductible way up because they're being pressured to do that. And sometimes the excess is relatively inexpensive. So they'll go, and this is across the board. What you're seeing is major companies around the world taking retentions way up, using the captive to formally fund those deductibles, parking money, formally funding, allowing for balance sheet protection for the company for doing that, because they may be going from a 250 to $1 million, or $1 million to 5, or 5 to 20. And that's why the captive is such a natural vehicle to kind of take on that volatility and park and kind of fund formally that premium every year. You take your premium credit, you put it in your captive. So you may not see excess work comp, but you certainly see excess liability being put into captives as well when there's a challenging layer, for sure.
All right. Okay, well, I'm going to move us on to the next slide, and we're probably going to end up sort of talking on similar subjects, but just a different spin on the growth here. And 15 of our domiciles where we have a presence and an operation saw increases in more than 20% in the premium volume. And I think it's more and more of the same, but I guess my takeaway from that is that it's across the globe. It's not necessarily just the US, which historically in a softer market, we've seen the growth in the US domiciles, particularly the emerging or the newer domiciles, the smaller states, but we're seeing it all over the place. And I think that's sort of a testament to growth in general. Do you guys want to comment on that, or would you prefer me to move on to the next slide at this point?
You can do both, and we can.
Okay.
As you're moving. So yeah, absolutely. I'm delighted to say that many of our international domiciles are within that, those top 15. And domiciles, Ellen, that we, that are mature as well. So,
yeah.
We're talking of, and some newer domiciles such as Dubai, but we're seeing, Dublin, Malta, in addition to these here. But the two growth stars, I suppose, from an international perspective would be Guernsey and Singapore. And challenging market in the UK and in the Pacific are really have driven the growth there. And I'll point to the, Marsh's Global Insurance Market Index, which tracks pricing, composite insurance, commercial insurance pricing quarter by quarter. Consistently for the last year have shown that UK and Pacific pricing increases have been north of 30%. Which is quite good. So they're in quite distressed markets. Whereas that's kind of half of that in the US and in other regions. So really then in the UK, I've mentioned it a couple of times, but that's what's driving a lot of the interest then in Guernsey and increased premiums, where we've got existing captive owners that are adding more premium to their captives, taking higher retentions, and then we have new captive formations. Singapore, the hard market started in Australia, which feeds a lot of our captives in Singapore. So that started in heavy industry and in mining some time ago. And so we saw a huge increase in the number of captives we manage in Singapore. And, that hard market started earlier, but it's still going strong. I mean, when you speak to Stuart Kings, the activity levels in both of these regions are just significant still. So it's not going away, even though it might have started earlier. It's got a lot of runway left.
Yeah, and Mike, really pleased to see the growth in Bermuda and Cayman. I don't think the 4% does the Cayman growth justice, in fairness, but those two domiciles are the matriarchs of captive domiciles, right? So it's great to see such growth, but it's not actually coming specifically from pure captives, is it? In the traditional word of the word captive, it's other types of vehicles, right?
Absolutely. So if you think about the 23% in Bermuda, that's $4.6 billion worth of new premium. And that's largely life insurance companies, commercial insurance companies, reinsurers, a lot of alternative risk. And interestingly about Cayman is that the growth in Cayman is great. And a lot of that growth is not healthcare. So Cayman has traditionally been known as a healthcare captive domicile, and it's an excellent domicile. But you're also finding a lot of insurtechs, startup companies that want to offer all kinds of agency or managing general agency or what's called managing general underwriter business, where you write property or workers' comp or renters insurance or cyber insurance. And you do it in a more creative, strategic, and scientific way using data and analytics. And a lot of these companies are basically forming captives to take some of the underwriting profit that they know is there. Just to go back to the 6% in the US, though, that's about $1.4 billion. And some of the top contenders in that domicile are someone like you had mentioned, Alan, are the emerging domiciles that years ago, just weren't on the playing field. And now they're all increasing. So that's DC, Washington, DC. And again, that's largely from some cells, but also Texas, huge domicile, and Tennessee, which is great to see. You get to see some of these trending domiciles that are moving up in the rankings, doing a lot of different, offering insurance to their home state companies. And again, some of the coverages are marine, business interruption, cargo, products liability, and professional. These are the top kind of 5 coverages from those domiciles, to just show you the nice spread of, it's not just your workers' comp, GL, and auto captives anymore. It's everything in between as well.
Yeah. I'm just going to try and hit another couple of questions. Since we're talking about domiciles, Margaret asked a little while ago, how reactive are the regulators to this increase in demand, basically? And I think they've been incredibly reactive. And everybody, including us as managers and the regulators and all the sort of captive infrastructures, have had to pivot and work with technology and virtual environments. We'll talk a little bit. We have a slide about some of the technology things that we've done here in Captive Solutions, but everybody's had to pivot and be a lot more flexible and nimble. And so, at least from my perspective, the regulators have done a terrific job. And where a faster solution is perhaps needed, we go back to our cell solutions. In Bermuda, we've turned cells around in as little as 2 weeks. And Donna Weber will hate me when I say that, and the team in Bermuda will hate me, but it is possible. But so I do think the regulators have been incredibly reactive. Another question that's come in, which I think is an interesting one. It says, what's the greatest demand that we're seeing to transfer into a captive that you currently can't do, can't transfer into a captive? And I would say that I would challenge that question, flip that one back and say, we can pretty much do anything in a captive. You may or may not need a front. That's perhaps the challenge there, or you may or may not need it rated, in which case you could have a rated front and admitted paper. So we thought side A, D, and O couldn't be covered. But we've proved that one wrong. So bring it on. If you've got a challenging risk that you think you may be interested in thinking about how a captive can secure some level of protection for you, then let's have a chat about it, because in my umpteen years, or donkey's years, as I would say in England, I'm yet to come up with a challenge where we couldn't do it in a captive. The question is, does it make sense, and is there value from doing it? But Mike or Lorraine, any comments on that?
The only comment I'll make is pandemic insurance. And, we thought that was going to be growing last year, but I think what's happened is companies had to deal with the issue at hand. We had to get through the pandemic. We're kind of getting there, vaccinations are up. But that, in my opinion, over the next few years will be something that will be looked at, just like cyber and professional environmental were looked at many, many years ago. Pandemic insurance, business interruption is going to be something that you'll see trending in captives. That's the only comment I'll make on that, Ellen.
Yeah. And Lorraine, a question for you while we're talking about domiciles. We don't tend to like to talk too much about tax, but a question from Eric's asked, most of the captives are in tax havens. Not entirely sure about that, by the way, and certainly not in the growth. How is this viewed by the tax authorities? Maybe you can chat a little bit about that, Lorraine.
Well, while some domiciles are in low or zero tax jurisdictions, not all of them are. Certainly not onshore in Europe. They're not, or any of our onshore domiciles, by that matter. And tax is no longer a motivation to form a captive. So it may have been in the very olden days, but certainly isn't now. And so when we're talking to captive owners, they're very conscious of tax and reputational issues in different domiciles, but we've even seen new formations in zero tax domiciles, such as Guernsey, where the captive owner is choosing to be taxed in their parent location, because what they want is the value of the captive, and the tax is of less of an issue for them. And so tax issues are important to consider, but they're not a motivation. So I would say that tax is becoming less important in our world.
Yeah, I would totally agree with you there. Mike, a question for you. At what point does it make sense to consider getting your captive rated? What would be the driver for that? Is it the size of the captive? Is it what you're writing? What would drive the decision there?
Yeah, just to give you a statistic, about 5% of our captives globally are rated by the larger rating companies like AM Best, S&P, Moody's. The number one reason for needing or wanting a rating, and the only reason captives really do get rated, is because they need it. They need it to provide certificates of insurance. They need it because of lender covenants. They need it because of some contractual relationship with somebody or some entity that requires a captive to get it. Or maybe the captive is reinsuring another captive, or the captive is reinsuring a fronting company. That is why you'll find companies getting it, because there's a process to it. There's a rating process. There's an annual process that you have to go through. There's scrutiny on your investments and your capital and your sort of governance. So great question. It makes sense to have a captive rated only when you need it. And there are many times when you do need it. I'll give you just one example. A large financial institution decided to self-insure E&O, and they got an A-7 rating. And now lo and behold, they were able to give all of the certificates that they needed to all of their certificate holders and not buy any insurance. And that really saved them some real dollars.
Awesome. Great question. Okay, now we're going to move on to our next topic, which is third-party business. So the first, let's just answer Jackie's question, Mike. What do we actually mean by third-party business before we actually get into this slide?
Sure. Yeah. So third party is not third party liability. Third party unrelated business means any premium or risk that is not related to your company. So a great example is employee benefits. It's the risk of your employees. They are not related to you. They are not related to the company in any way, shape, or form. They just happen to be employees. Another good example is extended warranty. When you buy something online or you buy a new car, you're offered an extended warranty. That is third-party unrelated business. And you're finding that this class of coverage is predominantly in a lot of our captives. We're up about 1% over last year. That means that almost 1 in 5 of our captives is writing some sort of unrelated risk in their captive. And that could be as a result of being an agency, a captive agency, or an insurtech company, or a home builder that's offering extended warranty, or multinational pooling of employee benefits, or employee benefits for that matter, gig worker economy sharing companies, pet insurance, trip cancellation. These are all examples of third-party insurance that's usually pretty profitable, that ends up in our captives, and it usually does need to be fronted. You can't just direct write this out of a captive, but it's profitable. It diversifies other P&C business. It creates stickiness with customers. It creates a great customer experience for large FIs and automakers. It's giving you that level of profitable business that you want to counteract some of that property business and the liability business that is volatile. So that's exactly why you're seeing so much third-party business over the last few years coming into captives. And we saw a $21 billion increase year over year for things like extended warranty, independent contractor insurance, or maybe professional indemnity. Cyber insurance is sometimes offered to third parties, franchisee business, agency captives, MGUs, MGAs. These are all great examples of lines of coverage that are coming into captives that are doing all of these different things, that are doing it better within science and data and technology. And that's why I think in the next few years, third-party business, and it has grown, and I've predicted that. And it's just a very interesting line of coverage to see in captives, and it's going to grow.
Yeah, we'll give you a medal for predicting it, but I think we all predicted it too, though, in fairness. But yeah, I mean, it's quite interesting, isn't it? Because a captive is all about retaining risk, or at least the word captive, if you think about it, it's captive risk. And so to offer sort of risk to unrelated parties or third-party business seems a little bit odd, but all of these types of categories that we're seeing here on the slide, they're unrelated but connected, and I think that's the key, isn't it? That the regulators are comfortable with this kind of risk if there's some level of control over that risk. So if you think about customer risk or employee risk, you can somewhat control that risk. So you're not going out into the world and selling it to completely unrelated parties unless there's some level of control over it. So. Lorraine, any comments from you on third-party business?
Yeah, I just, for any international captive owners who are scratching their heads at looking at employee benefits in this box, from a regulatory perspective, regulators outside of the US look at EB as group risk. So it's not actually, they don't view it as third-party risk. But certainly that's growing a lot. And what we're seeing as well is, if I look around at that circle, I see extended warranty. We're seeing a lot of that. We're seeing MGU, a lot of interest in MGU as well, and EB, although not voluntary benefits. But also I see some runway in sharing economy. I can see that definitely going to be in some of the inquiries that we're getting. I see that's definitely going to be. So our crystal ball, what's
yeah, we have a crystal ball, don't we? Yeah. And Tim. So just to answer your question, I think Mike mentioned it, but it was in amongst a bigger paragraph. But why are companies thinking about this? They're thinking of it really for sort of three reasons. One is it's typically very, very profitable risk. If you think about every time you may have bought an extended warranty contract, you probably even forgot you ordered it, you bought it. So that premium flows typically via a fronting carrier into the retailer's captive, for example, and it can be incredibly profitable business because the loss ratios are typically quite low on some of this risk. It can diversify the captive. Maybe you've got some property in the captive, or some comp in there, or employee liability in the captive. Adding some level of third-party risk in there like this can really diversify the captive, and the captive starts to act and breathe and smell like a real insurance company. It can also, I think Mike mentioned this one, create stickiness to customers, for example, or to employees. If you're able to offer something that your competitors are not, captives are used as a real hook in some situations. So there's a number of different reasons, and we're definitely seeing growth in that area. But we're coming to a bit of a close now, and Thank you both, Lorraine and Mike, for all your insight. But before we close, I wanted to share with you guys and the clients on the line a little bit about what Marsh Captive Solutions has been doing. In 2020, again, it was an unprecedented year, and many organizations pressed the pause button a little bit and considered how they were operating in this new world. And many of them, Marsh included, launched an ESG report, and we launched our first ESG report not too long ago, and have committed to certain benchmarks, reducing carbon emissions by 15% below the 2019 levels by the end of 2025, and to be carbon neutral by 2021. I'm very proud of the way Marsh has sort of taken the bull by the horns here. And in Captive Solutions, we've also started to consider this and how we're making a difference. I mentioned technology and the virtual workplace. We were all forced to do that, but we were lucky enough that we were able to do it very, very quickly. Our phenomenal Captive Solutions IT folk quickly instigated DocuSign for all of the colleagues globally, which is quite the achievement. And we've sent, our statistic is we've sent 6,200 DocuSign envelopes, delivering 12,000 virtual board meeting packs, and issued more than 40,000 digital payment signings. That's pretty impressive. So our technology has certainly kept up, and that has helped us decrease paper usage, led to an estimated environmental savings of 9.2 thousand pounds of waste, 56,000 pounds of wood, and 132,000 pounds of carbon. We're also very well aware and very conscious about our inclusion and diversity efforts within Captive Solutions globally. We are in 19 countries and speak fluently 40 languages, and 7 of our offices have female and/or minority leaders, with women making up 60% of the team, which Lorraine and I are very pleased about, of course. But we're extremely conscious of this. We're very proud of this. And I know many clients have been talking to us about what they've been doing. And so I wanted to share a little bit about the journey that we're on too, and more to come on that as we roll it out. The landscape report, we're hoping to have a feature on this, particularly around how we're helping our clients with some ESG initiatives as well. So I think that's going to wrap us up. I told you it was going to be more than 20 minutes. I promised it would be less than, well, 40, but it's actually closer to 50. So apologies for that. But I think we had a great discussion. The landscape report, as a reminder, comes out mid-September. We will send a copy of this recording out to, will be available with the deck. And also, if you have any further questions, I think we covered just about most of them, just about all of them. If you have any more questions, then do please reach out. We'll provide contact details in the deck also. I think that wraps it up. Look for more information to come as we get more into 2021 statistics, because the growth is continuing, folks. And we look forward to chatting with you all personally. So thanks again for joining, and we'll see you soon. Thank you.